from freefincal, and in this video let's discuss the mutual fund FMP crisis surrounding the Z promoter companies and uh, how can investors protect themselves against such a problem if they can, and what should SEBI do in this case. So before we begin, a disclaimer: I'm not an expert of the bond market. I was not very deliberately not following up the news surrounding this. But I was asked by a reporter to comment on this, so I had to do some research. So I thought, why waste that research? Let me make a video. And I think a couple of people also asked me about this. But there's not really much interest in terms of viewership for FMPs or debt funds in general compared to equity funds. So I'm not an expert. This is my understanding, and I could be wrong. If I am wrong in some aspect, please correct me. So what is a fixed maturity plan? First of all, it is a debt mutual fund. It will hold bonds. Second of all, it is a closed-ended mutual fund. So a fixed maturity plan will open as a new fund offer for about 2 weeks. You can buy an FMP only during the NFO period. After that, it will close for sales. After 2014, all FMPs typically now have maturity periods of 3 years and more, a little more than 3 years and beyond that, because of the change in taxation rules. Before that, there was something called double indexation benefits and so on. I don't want to get into that because it's not relevant now. So this means that the FMP will close after the NFO period is over. Then it will mature, let's say after 3 years. It will be a little more than 3 years, but we'll assume it's 3 years for this video. After 3 years, then all the money will be converted to cash and distributed to unit holders. So that's essentially how it is. What the fund manager will do is they will buy bonds which mature a little bit earlier than the 3-year period, that is, a little bit earlier than the maturity of the FMP itself. So by the time of the maturity, all the money will be converted to cash and ready for distribution to the unit holders. So the idea of an FMP is that because the product is locked, and because the maturity profile of the bond matches the maturity profile of the FMP almost, interest rate sensitivity will be low. There will be credit rating issues as is evident now, but interest rate sensitivity will be absent. To understand how a debt fund works, please, I would urge you to search for debt mutual funds in my channel. I have plenty of videos. I have an ebook on what is a debt fund, what are the risks, how to start investing in them, and so on. The ebook is linked below. I will link some debt fund videos around this video, our previous debt fund videos around this particular video, but you'll have to search for others. So what is credit rating risk in a debt fund? So let us say I am the fund manager and you are the investor in the FMP. Let's say it's a 3-year FMP, and I have given my money. So that is the money I'm managing. That is your money. I collect money from you. That's the money I'm managing in the fund. I take this money and I lend it to a company, several companies. One of them has to give me, let's say, interest payment twice a year. It failed after 6 months. It failed. The interest rate payment did not come. So I checked with the company, found out what was happening, and they said, "I'm sorry. Please do not default to me. I'm very sure we will guarantee this. We have some temporary problem. We will you will pay 2 times interest after 6 months." These kind of things happen all the time. So sometimes it works, sometimes it doesn't work. As it has happened in this case, it does not work in the Z issue case. So if they give back if they pay back all the dues, then it's no problem. Everything will be okay. But in case they continue not to pay, then I realized that there's something deeply wrong with the financials of the company, and they will not be able to pay. They are saying that they will pay. like every person in debt would, but they will not pay. Then I am having 10% exposure of all the assets. 10% of all the assets in that mutual fund are being held, have been lent to that company, which is now in trouble. Therefore, I will declare that lending as default, which means that I will essentially call that 10% of money given to them as worthless. It's gone. So the NAV will fall down by 10%. This is the credit risk in mutual funds. Of course, so the credit rating agencies, they may, suppose it's a AAA bond, they may change the AAA bond to AA, some other bond, not this guy. That will be too bad, too much of an overkill to call such a company as AAA. So let's say a AAA bond, which is the highest rated bond for according to one agency, has become a AA bond due to a change in its financial structure. Then the NAV will fall a little down because the NAV of a debt mutual fund depends on two things. It will increase every day a little bit, very, very small amount, due to the interest rate payments that come in. So the interest rate payments given twice a year will be divided into 365, and that small amount will be added to the NAV every day. In addition to that, the market value of the bond will also be used to calculate the NAV. So which means that, so if this guy, let's say I bought the bond at 1,000 rupees per bond, suppose this guy starts to default, the value of the bond will fall down in the market. So the 1,000 rupees will become 800. So that will show in my NAV. Suppose a AA rated company becomes a AAA rated company, then the value will increase. Then my NAV will also increase. So both ways it is possible. So that is the credit. That is how credit rating plays out in debt mutual funds. I mean, I've given you a very simplistic idea. You can read more in the ebook, or you can see past videos. So what has happened here? So these FMPs from Kotak, HDFC, maybe other AMCs are also going to be in trouble. I think ABSL is also in trouble, if I'm not wrong. I saw one of their FMPs fall down. It could be because of this or something else. I'm not sure, but it could be. So the problem stems from two bonds issued by Conti Infopower and Edison's Utility Works. These are Z promoter companies, that is Z Entertainment borrowed money from mutual funds and other agencies via these companies by pledging Z stock as collateral. This problem started in January, not in April, or not just a few days ago. The collateral, that is the Z shares, fell by a huge amount in January, late January, I think. So when the collateral becomes worthless, the lender can call the bond as a default, as worthless. As I can just mark the bond as default. So Z Entertainment called a meeting with all its lenders, including the AMCs. I think Kotak was there. I think HDFC was there. I think definitely ABSL was there. I can see the quote from them. And they came to an agreement saying, please do not sell these Z stock. Then if you start selling, there will be further panic because the stock is already falling. Do not sell, do not mark, this is important, do not mark the bonds as default. We will find a way to sort it out. So the AMCs decided to give time until September 2019 for the problems to sort out. Oh, this is where the problem is. The big issue is, they were holding these bonds in FMPs, and these FMPs were maturing in between January, when the pact was made, to September, the deadline. They were maturing all over. What would happen to the fate of these FMPs? Because if the FMP matures and the interest has not come back, the principal has not come back, they will be in a loss. The bond has to be marked as a default because the FMP is mature. This is the problem. Now, they had agreed not to call it a default. The FMP has matured, they have still not marked it as a default. This is nonsense. At least Kotak has said, look, we are having problems with these companies. We will, that portion of the NAV alone, we will give back to you later. You please take the rest of the money. We'll find a way to solve it. At least, well, even if it is not completely transparent, completely the right way to do things, whatever you want to call it, at least it is something. I would say it's a step in the right direction. HDFC is even worse. They say, in the interest of the unit holders, because of possibility of increasing yields, blah blah blah, we will extend the maturity date of the FMP by 368 days, I think. What logic is this? You will not mark it as default because you agreed. You came into an agreement. I'm assuming HDFC was also part of the AMCs which did it. There is no reason, if HDFC is not part of the AMC which agreed, please let me know. I don't see why else they should behave like this otherwise. How can they come to, this is my problem, how can they come to an agreement when there are mutual funds maturing? This is an FMP. If it's an open-ended debt fund, at least I can understand. This is a FMP that has to be closed, shut down and wound up, money given to investors. How can you agree when you are holding such a shit bond in such FMPs? And now give argument saying in the interest of the unit holders. Once they say interest of the unit holders, there will be a bhajan goshti of the distributor saying, oh yes, in the interest of the unit holders, yes, we should stick with the FMP and so on. Of course, there's a choice. You can roll it over for 368 days, or you can get back at current NAV. What is that current NAV? That NAV has to be decided. The AMFI has to come together and decide that NAV. I don't know if they have done it. You should actually call it a default, but they agreed not to call it a default. This is, I don't know what to call it except shady. Of course, that's how it works. You can't call this alone shady. There are a lot of shady things going on everywhere. But the point is, see, if I am the fund manager and this thing happens to me, and if my FMP matures in December 2019, I can say, okay, you are having trouble. I think as a company, you are financially solid. I will give you time until September. But if my FMP is maturing in April and May, how can I give you time until September? What logic is this? Oh my God. So this is something serious that SEBI has to wake up and take a stand on. So, oh man, this is painful, isn't it? This is my understanding. I think if I'm wrong, please correct me. Even if HDFC did not come into that agreement in January with Z Entertainment, they have no business to stay in the interest of the unit holders because of yields and so on. They didn't even explain this as a reason for rolling over, which is atrocious. So what should investors holding those FMPs do? First of all, okay, I think if you are holding bad FMPs and if you are being given an option to roll over, do not roll over, get out. Get out at whatever NAV they give you, because I don't know how to, even if they roll over, I hope I can show this. Even if they roll over, let me get a fatter pen. So let's say that's the current NAV, somewhere here. Before they roll over, they will have to mark down the assets. So the NAV will fall down like this, vertically. Then during the rollover period, it will gradually come back up. So if you exit now, you will have this much loss. If you don't exit and hold on, there will be some kind of recovery. Assuming there is some recovery, we will assume there is some recovery. This will take this much time to recover, but time is money. Remember, you lost money because of time. So there will always be a loss. Better to get out now and get out of this shady dealings than hold on to this and hope that it will be recovered. This is what I would suggest. Please recognize time is money. The NAV will fall down. This markdown should be a default, but AMFI I think has to decide how much this markdown is. and then it will slowly, gradually move up and come back to its pre-crisis value if the money has come back. If the money is, if everything is sorted out and they are able to pay back all their dues. Otherwise, it will not. So that's one thing. The second thing is, how can investors protect themselves? Honest answer is they cannot. Because the way in which it is structured, FMPs, debt funds as a category, and FMPs in particular, there is no style purity. There is no FMP today that will only invest in corporate bonds, which are risky. There is no FMP that will invest only in bank bonds, only in PSUs, only in short-term gilts, only in long-term gilts. If there were, then the investor who is worried about credit risk can choose short-term gilts or long-term gilts. There will be absolutely no problem. Interest rate risk will not be there because it's a closed-ended fund. Credit risk will not be there because it's a gilt product. There's no problem at all. Whereas FMPs, they are packaging everything. They're taking, it's like a khichdi. They're taking this, little bit of that, little bit of that, little bit of that, and they are taking on more and more risk to provide returns to investors who have been, in most probability, missold this product as a product that will give you this much yield, that much yield. How can you sell an FMP without telling an investor it will give you approximately this much yield? It's not possible at all. Although on paper they should not say. Please put yourself in the shoes of a salesman. Will you be able to sell an FMP to anybody without giving them an indicative yield off the record? And they are being told that they are as good as fixed deposits. They are more tax efficient than fixed deposits and so on. So it is simply not possible in the current structure to safeguard yourself from these problems in FMPs. So I would say stay away from FMPs unless you can find a style pure FMP. SEBI should change their mutual fund categorization rules and make sure there is style purity, gilt only FMPs, corporate bond only FMPs, to ensure investors have better choices. Will SEBI do it? I doubt it seriously. SEBI should also ensure that if fund houses are going to make agreements with lenders about not marking, about manipulating market value. That's what they're doing. When you say I'm not going to call it a default, you're basically manipulating the market value of the bond. Essentially, if they are going to do that, first of all, they should not do it. If that is too much of a rule to impose, then at least they should not do it when the bond is maturing in the FMP before the deadline they have given the borrower. In this case, the deadline is September, the maturity is April, May. At least that much should be avoided by SEBI. As always, our regulators will not be proactive, they will be reactive. Something bad will happen, then they will react. As investors, at least, let us be proactive. What about open-ended mutual funds? Open-ended debt funds also have problems. But at least there are some options where you can at least stick with overnight funds, liquid funds, and so on, where there at least from some AMCs like Quantum, there is you have some reasonable probability of such an issue not happening, although it's not zero. So that is all there is to it. It's the more I read about it, the more I feel yucky. It's a terrible state of affairs. If you have any questions, comments, or if you think something I said is wrong, please let me know, and I'll be happy to learn. I'll catch you again in another video. Bye bye.